Chapter 25, Examples for Principles of Accounting 2. In Chapter 25, we look at performance evaluation of individual divisions and some of the measures that we use for evaluating performance for managers. So one of the key measures we use is return on investment. We can look at the return on investment and we can use the DuPont method. So the DuPont method, we look at return on sales and capital turnover. Return on sales times capital turnover equals the return on investment. To calculate return on investment, we take the operating earnings of the organization divided by their average investment. And to get the hotel as a whole, we will add together the three divisions' earnings and divide by the sum of the three divisions' investments. Change all of these to a percentage. And we see that hotel rooms has the highest return on investment. To calculate return on sales, we calculate the net or the operating earnings or net income divided by the average investment. So some of the reasons that organization, not the average investment, by sales, operating earnings divided by sales. I'm getting ahead of myself in my talking here. Some of the reasons that ROI and return on sales and capital turnover are sometimes considered as faulty measures is because we have a wide variety of things that affect our earnings and what our investments are calculated as. And what some of those things are is that, for example, the depreciation method that we use. So the depreciation method that we use affects how our investments are carried in our books and what the value of them are. We also have that some people use operating income for these calculations, some use the net income for the calculations, and by making different choices, it's hard to really compare what one ROI is saying over another ROI. Capital turnover is the sales revenue divided by the average investment. As we can see when we look at these three divisions in comparison to each other, in these measures, the hotel rooms manager is performing better than the other two managers on all of them. So the second question that we have is to think about that the health spa is considering installing new exercise equipment. And we know that the equipment is going to cost $60,000, and we predict that having this equipment is going to increase our operating earnings by $10,800 a year. So first we want to know what is the return on investment of the exercise equipment, and then what impact does buying exercise equipment have on the health spa's return on investment as a whole. So exercise equipment ROI. This is calculated by taking the projected income caused by the exercise equipment divided by the cost of the exercise equipment. So the equipment purchase ROI is 18%. The health spa's ROI after the investment, we would calculate that by taking the health spa's income adding the increase in income of $10,800, dividing it by the health spa's investment plus the new cost of the equipment. So what we find is that investing in this new exercise equipment would increase our ROI overall by almost 30%, which then means that yes, the manager of the health spa is motivated to undertake this investment. Part 3 asks us to compute the residual income for each department. Residual income is another performance measure that helps to control for some of the issues seen by ROI measures. What residual income shows us is what is the extra or residual income left over in each department after looking at the minimum required return on investment for the organization as a whole. So we're told that the hotel's minimum required return is 15%. So to calculate residual income, we take the division's income minus their average investment times the percentage of rate of return required by the organization, so by 15%. So for restaurants, we will take restaurants' operating earnings minus their average investment times 15%. And for the health spa earnings minus their average investment times 15%. We would anticipate that the restaurants and health spa were going to have negative residual income. And why we could have predicted that is because neither one of them is meeting that required 15% ROI. Only the hotel room is over the 15% ROI. We're going to extend this example into talking about the balance scorecard. So we have the same hotel, and we notice that the managers of the health spa and the restaurant have a lower ROI than the hotel division. Well, the manager of the restaurant is complaining that the reason the hotel's ROI is so large is because they keep cutting housekeeping staff, and that the cutting of housekeeping staff means that they're losing customers and the hotel is losing its reputation. And because of this loss of customers and reputation, it is negatively impacting the amount of sales revenues in the restaurant. So the manager of the ROI says that he has to keep operating expenses under control and that cutting the wages of the housekeepers helps him maintain his high return on investment. So the manager of restaurants has asked for other performance measures to be implemented so that the hotel manager isn't incentivized to cut valuable staff that is hurting the organization as a hotel. So that's one of the complaints of return on investment, is that managers will make decisions to boost their return on investment that are bad overall for the organization. This is one of those occasions. So not having housekeeping staff is meaning that customers are unsatisfied, they're losing their reputation, they're not keeping customers. So when we create a balanced scorecard, we have 4 characteristics in the balanced scorecard. So we have customer perspective, financial perspective, internal processes perspective, and employee training perspective. So when we're looking at creating a balanced scorecard measures that we could evaluate the hotel rooms based on housekeeping, different things that we might want to look at are customer satisfaction. Do we see an increase or a decrease? We can do customer surveys. We can see the amount of customer complaints. We can look at change in revenues. That's a financial measurement. between the departments, especially looking at hotel rooms. We can also look at, for an internal process, we can look at the number of hours that housekeeping staff currently has versus the number of hours that it should take to clean a room and what kind of hours we have available. We can look at housekeeping staff productivity, but what some of the main measures that would solve this particular problem are those customer satisfaction measures. The last example that we have here is looking at a division that was purchased by a company. And this division historically has very high return on investment, higher than the company's minimum rate of 12%. Even though they historically have a high return on investment, they're still rejecting investment opportunities. So we want to calculate what their ROI is and what their residual income is. So their return on investment, first we have to have the average investment. So unlike the first example, this example does not give us the average investment. It just gives us the end of year investment. So the end of the year investment is this $14,310,000. To get our beginning investment, we see that this is a 6% increase over the previous year end. So we want to take that and divide it by that 6% increase, or 1.06, or 106%. This gives us a value of 13,500. So to get our average investment, we add these two together and divide by 2. Our return on investment is the operating income divided by our average investment as a percentage. If we do capital turnover, this is sales divided by the average investment and the return on sales, which is the net operating income divided by sales. And the residual income, which is our net income minus our average investment times the required rate of return. For this organization, the required rate of return is 12%. So our residual income is over $1 million that we're contributing above our required return and the 20%. Based on this information and based on the information that that investment was also over the required rate of return of 14%, this division should not be turning down investments, thinking about how it affects their ROI. That they should be taking any profitable investments and not rejecting things.